S.D. Bullion.
This is the Doc and Eric Dubin with SD Weekly Metals and Markets Wrap. No break from the chaos in the markets this week, Eric, as gold and silver were absolutely hammered all week in advance of the Bank of Japan's Kamikaze plan to increase QE to really an astonishing 50 trillion yen a year, which was announced early Thursday morning. We saw silver close the week back above the critical $27 level at $27.35. It was up nearly 50 cents on the day, and gold closed the week at $15.83, up nearly $30 on the day, and well off its lows near $15.50. Quite a week in the markets, Eric.
Yeah, and we closed on a good note too with respect to the gold and silver prices, nearly on their highs of the day in the access market. Typically, the gold cartel will try to keep gold in particular in a limit of 1% upward moves. And if it does get away from them, limiting it at 2% or so, and if you look at that statistically over the course of the last 12 years or whatever, the frequency of that happening is just astounding, and it argues against anyone who would claim that there's no manipulation or management of the pricing action. That stuff just does not happen that way in typical commodity markets. So here we are. We closed in the access market on near the high for gold and silver, and it shows in some respects the price getting away from cartel efforts to keep it locked down. Yesterday, when the Western markets were reacting to the news out of Japan, it was no surprise to see gold and silver capped to keep the excitement down and fears of inflation tapered down.
Well, we'll get back to the Bank of Japan in just a moment here, but I'd like to touch on the widening or escalating physical shortage of both gold and silver, but particularly silver here in the States. Tomorrow on Saturday, we're going to be publishing a story on silver doctors that really even globally, there's beginning to be a gold shortage pop up as well. A reader of SD in Bangkok, Thailand, sent in a firsthand account that all the precious metals dealers in Thailand are bone dry of gold. There's not one single ounce to be found, and usually any physical gold coins that you want can be found. And here in the States, physical silver is rapidly evaporating. The 90% silver has been a growing shortage over the past really 2 or 3 months. The shortage continues to escalate. What we're seeing with wholesale suppliers, one of the largest wholesalers in the country now has actually completely stopped selling it. They've informed us they can't get any. They don't have any. They can't get it at any price. At least they're not selling it at any price. And several of the other largest wholesalers are nearing $3 over spot per ounce that they're selling it for. And it's on nearly a 2-month delay. So just more evidence of the widening and escalating shortage of physical. And even in the mint products, the silver maple and the silver eagle is about on a 1-month delay. The premiums aren't spiking quite like we saw them in January when the U.S. Mint completely stopped production, but we are seeing a shortage based on the 1-month delay. So just more signs of a tightening shortage in the market.
Yeah, and people will frequently respond to that by saying, hey, we can still get coins in our local coin store or what have you, but if you go to the larger coin stores, larger dealers, you will see these higher premiums, and you will see longer wait periods for delivery of product, and that's the first stage you would expect to have to endure when it comes to a tightening market. Yes, the silver's still there, but it takes a heck of a lot more time to actually obtain it, and we'll continue to see that going forward as the market gets tighter and tighter. It's also pretty interesting that we continue to see institutional holders of gold and silver for high net worth accounts beginning to close the door on deliverability of the so-called allocated positions that wealthy clients have. The latest being ABN AMRO out of Holland, where they're no longer going to let their customers get the gold and silver that they have in their accounts. So, that speaks volumes. There's just no gold and silver available available in large quantity. If somebody wants to spend enough to buy a tube of maple leaves or what have you, yeah, you can find it at a local coin store. But when it comes to real big dollar purchases, the shortage is on. It's already here. We can see it, folks.
Jump right over to the big story of the week, which in my mind was the Bank of Japan's big QE announcement. 50 trillion yen a year, and they're not just buying bonds. They are buying bonds across the spectrum, short-term, medium, long-term debt, but they're also buying equities and real estate. So they're printing money basically to buy everything, to stop deflation in any way possible. And Kyle Bass, we published one of his talks at a conference a couple weeks ago, earlier in the week, and he really made the case, and has been also, I think he was on CNBC yesterday, really making the case that Japan is really about to get hammered once interest rates spike. And we actually saw that really in the 12 hours after the QE announcement. Their bonds initially, the yields turned down, but the interest rates actually spiked overnight, and the Japanese bonds had, what was it, one of the biggest collapses in over 10 years. The Japanese actually stopped trading their bonds. They triggered circuit breakers early this morning. I think it went something from like around 30 basis points up to 65 basis points. So we're talking really a doubling in just a few hours. So just a massive move in Japanese bonds. Really, Eric and I were talking before we came on the air here, and it really reminds me exactly of back in November of 2011 with the big takedown of gold just in the 5 minutes prior to the Swiss pegging the Swiss franc to the euro, and just a completely obvious takedown of gold just prior to the announcement. And really this whole week's takedown of gold and silver strike me as preparing and getting ready for the big Japanese shock and awe QE announcement Thursday.
Yeah, and the context of it also comes in the broader time frame of the last 6 months or so that we've seen gold and silver under great pressure. Given Goldman Sachs' call in November of 2012 that they believe the gold market would peak in 2013 based on QE coming to an end earlier than expectations and the economy getting a footing. Now, fast forward to today, and here Japan announces this bombshell. We are beginning to see signs that the Fed has room to backtrack, to begin to talk about QE being expanded, and noteworthy economists in the United States, such as Michael Woodford, Columbia professor, is now openly talking about QE never ending. I mean, there's the same quality and perspective that Jim Sinclair has been talking about, because basically he recognizes that you can't turn this faucet off. The bond buying would end, or rather, better said, the support for bond buying. And the United States still is able to push some of its bonds on a safety trade because the rest of the world is just up in flames with Cyprus and so forth going on. But yeah, QE can't end until the system actually goes through a reset, because we need QE to purchase and support our bond market, to keep the banks in appearance solvent. It's now at a stage where, since Japan has launched its major debasement of its currency and QE support for its bond market and economy, it's likely that 3, 4, 5 months from now, the spotlight will be shining very brightly on the United States again. Dollar fell pretty strongly today, and I think that people are beginning to come to terms with the reality that the economy is nowhere near as strong as the pundits and policymakers have been trumpeting in the last few months, and this whole illusion that they've been trying to carry is falling apart. That speaks very strongly to further fundamental support for gold and silver prices, and I expect that we've bottomed. It's possible that we'll fall further if J.P. Morgan and their friends would like to figure out one way or another to push running of stops orders, stop loss orders, so that they can cover shorts. But as it stands, the games that the powers that be have been playing to put forward an illusion of a U.S. economy getting strained and the unemployment improving is not an illusion that I think that they can carry forward any further. The reality is so ugly that it's beginning to show through.
Right, we had a huge miss in unemployment. Non-farm payrolls released this morning. In the labor participation rate was back to levels last seen, I think it was 1978, so we're at levels last seen over 30 years ago.
We have a decline in the unemployment rate, but the number of jobs was a pathetic 88,000 increase.
Let's not forget too much. The deposit confiscation meme was kind of driven out of the news cycle a little bit by some of the events of this week, but really it hasn't gone away. It really continues to escalate behind the scenes. Just yesterday, the CEO of UniCredit came out and called for a common solution in Europe, and he said it was acceptable to confiscate the savings to save the banks. Of course, he probably would say that because he's the CEO of one of the biggest banks, but he really went a step further, and he called for a global coordination of deposit confiscations to rescue failing banks, and said it was acceptable if it became a European solution. So really, we've got the bankers stealing from both ends of the spectrum. They're continuing to push towards outright confiscation, theft, direct in-your-face theft, and also the backdoor theft of currency devaluation through quantitative easing.
Yeah, well, it just goes to show how big the problems are. I mean, they can't fix it with strictly a single policy option. They have to spread their tentacles around and try to plug the holes as much as they can.
I know you and I think there's a strong chance that both gold and silver have bottomed here, especially with today's strong reversal. Gold moving strongly off of 1550. It didn't quite close back above 1600. As you said, it was capped really at the cartel's 2% daily gains cap. Silver did, however, close back above 27, and I think it's been the fifth or sixth time now, 26 has held for silver.
Yeah, fifth time since 2 years going back, and readers should take a look at the website for the chart that we're going to include in this week's program. You can see it very clearly that we have bounced every single time when we come near 26.
We'll keep our eyes open next week. We'd like to see gold get back above 1600, and really 1615 was really kind of the top of the last move, so I'd like to see a close or two above that before we can really start, say, with confidence that we've seen a bottom. And silver, really like to see it get back into like the 2850 to 2950 trading range, and then clear out of that to the upside and get back above 30. The short interest is so monumental that once that move begins, you're going to see a massive short covering to the upside, I think.
Yeah, and it's very interesting that there's this dichotomy going on where in the silver market, open interest has remained very high, and in fact is now at a multi-year high, whereas gold has been declining in open interest, suggesting that there has been a good deal of short covering going on. So, the investors that are in silver are deep pocket investors, and they're not giving up. They are willing to see price decline to that old $26 floor and then expand their holdings even further, which is probably driving Blythe Masters and JP Morgan in general pretty crazy. But that sets the stage for some pretty explosive upside action if, in fact, the short covering has to occur with higher prices to flesh out the positions. And I think there's a pretty good chance that that kind of action could happen in the price, but it'll be probably slowed down once we get past 32 or certainly 34 within a month or three in time frame, simply because there's been so many people who've been buying at higher and higher prices and don't have the conviction to hold. We have likely bottomed, and it's likely that we will sail into the 30s in the not-too-distant future. It's going to take a while to heal. There's been a huge amount of carnage in the precious metal space. But as far as the risk-reward is concerned, and as far as the value of holding precious metals for the sake of having insurance, the thesis behind those two primary reasons for holding metals has never been shaken. And the fundamental forces that are behind the rise in precious metals also remain and have only grown stronger. So it's painful to go through periods like this, and it's easy to get really excited when prices move higher and completely despondent when we go through periods like we have in the last couple of months. But I'd encourage people to think of the big picture. If you feel like you've taken on maybe too large of a position and it's hard for you to hold through periods where we go through corrections like in the last couple of months, then it's wise to scale back a little bit. But I'd encourage people to hold on to their insurance. These are crazy times, and the long-term ability for gold and silver to remain stores of value that hold their value is time-tested at 5,000 plus years. They have never had more important reasons for holding them now, because unlike any time in history, we're at a point where the entire global economic system's trading mechanisms through the dollar-based currency trading system and the insolvency status of most of the Western banking establishment are combining to create what will ultimately create just complete chaos when it comes to the transition to whatever kind of system the powers that be are able to effectuate in the coming years. And we really can't tell exactly when that's going to come down. It's probably not going to be something that will happen in the next 6 months or so, just because the power of QE remains. It hasn't been completely undermined in terms of people's confidence in the ability of the Federal Reserve and other central bankers to keep or watch our back. But the confidence continues to erode, and that's what the take-home point is about all of this commotion with Cyprus and bank runs and so forth. So the fuse has been lit, and it's just a question of how long the fuse is.
Couldn't agree more as far as the long-term fundamentals. I first entered the gold market around $278 an ounce, and the silver market was in the fours back in right around 1999 or 2000. And really, I can honestly say the fundamentals have never been stronger. Even where we sit at today, 27 plus silver and 1583 gold. The fundamentals are stronger today than 12, 13 years ago. So for those who are able to endure the pain, sit tight, and ride the bull market through its duration. That's it for this week. So look for the markets to continue to digest the Bank of Japan's massive QE plan over the coming week. Really, there wasn't much of a move in gold and silver early Thursday in response. Look for that to change as the markets really start to digest the move, and look forward to the Fed's counter move to come. I guess that'll be QE5 when it's finally announced, and as well as the continued ramifications for the Cyprus depositor confiscations over the coming weeks. So we'll keep an eye on all that. And for the Doc and Eric Dubin, thanks for joining us on the SD Weekly Metals and Markets Wrap.